a little bit about us if you don't know. So you're probably sick of hearing about me if you come to these sessions a lot, but I'm a Chartered Financial Advisor, Fellow of the PFS, and we help all sorts of clients with their money. But I think overwhelmingly what they all have in common is 90% of our clients have never ever had advice before they come to us. So we make it not scary and very approachable. And Heather has been a client and a friend, I don't know, maybe 20 years.
Probably, yeah.
Running her own business, but also lots of other businesses. So I wanted to get her on the podcast because she's a fountain of knowledge. So thank you, Heather. I'll let you tell us all about you.
Sure. So yes, I'm the founder of 𝗙𝗵𝗿, which is an employee-owned accounting and financial advice, business advice firm. We've been around for 22 years, and I am the finance director for a number of other businesses. That's part of what we do. And yeah, also a charity trustee of a few different charities. So I'm here to hopefully answer all your questions about what to do with all your business wealth.
Thank you. Well, I'll move to the next slide. Oh, the legal bit first is today is obviously not financial advice from Heather nor I, but we can give advice on a one-to-one basis afterwards if you need it as well. So shall I hand over to you, Heather? Do you want me to introduce the slide?
Yeah, sure. So what we're going to focus on today is those of you with businesses that have been successful already, and you have money that you're trying to decide what is the best thing to do with it. So the first and most important thing is never let the tail wag the dog. Don't let your accountant tell you what you should be doing. It's all about what are your personal goals? What do you want to do? And whether that's saving money for your family or providing for other dependents, etc. Or do you want to be a millionaire? You know, whatever your goals are is the first and most important thing. You should start at that. And then you can ask yourself both what can I do personally to help achieve those goals, but what can I do with your business if you're a business owner to help you achieve those goals as well? So Lisa, I'm sure you know everyone has completely different personal goals, different priorities. They're at different ages. Is there any kind of common link between everyone, or is it all unique?
Well, I think the common ground is a lot of people lack imagination to have their own goals and to have them personalised. I think most people assume, oh, I'll retire in my 60s because that's what everyone in my family's always done. I don't think people take time to necessarily write really personalised goals. And there are 3 questions that I go through with clients to try and really dig deeper into their questions. And I'll dig it out now and put it in the chat, but they're called the Kinder questions. And they're sort of 3 questions just to help you understand perhaps with a bit more depth what your goals are, your time frames, what's important to you.
Oh yeah, that is interesting because you know, if you don't know what you want, it's very hard to take directed action to get there. And one of the things I'm going to mangle this story, but you'll know what I'm trying to say. There's the classic, you know, fable of a high flying man goes out to the country and sees a fisherman fishing, and he says, "Oh, you know, what are you doing?" He said, "Oh, I'm fishing for my family." And he says, "Oh, but you know, if you could get a boat, you could actually get more people and get even more fish to get even more money." And the guy said, "Well, what do I want to do that for?" And he said, "Because then one day you can retire and sit around fishing on your own." And he said, "I'm already there."
Yes.
You know, so sometimes the accumulation of wealth for its own sake isn't useful. It's important to know what you want to be happy with. Yeah.
And I think I struggle with that as well.
And also it's different at different periods of life. If you've got a young family, you're almost always just thinking about the kids. As you get a little bit older, you probably are thinking a lot more about retirement and health. And of course, your personal goals can change over time. They're not static from the first time you think of them. So yeah, so some of the things we're going to talk about today is what are some interesting ways you can use the cash you have in your business to help with some of your personal goals. I know for most people, one of their personal goals is to become mortgage free one day. And that might seem a really long way off in the future. But there's a great way if you've got a lot of cash in your business that you can essentially shift your mortgage, if you will, from a commercial bank where you pay much bigger rates of interest to have your company loan you the money at a much smaller rate of interest. It's not as simple as just shifting it. There's other tax things you have to be aware of. But if you've got a lot of money sitting in your business and you don't want to take it all out and pay personal dividends on it to pay off your mortgage, you can use your company as essentially as a lender to pay off your mortgage. And then you need to pay your company back, of course, including interest. But that's a very, very effective way of getting out of the expensive mortgage trap. Lisa, is it worth me explaining a little bit about how one would go about it, or if it's too tax heavy?
Some top tips would be great, because I know there's a huge amount of people coming off very, very low interest rates now, sort of less than 2%. So I'm sure ears will be pricking up.
Yeah, as long as you can get a commercial mortgage that's lower than the HMRC's required rate of interest, you should stay where you are. But definitely if you're in a high interest mortgage situation and you can pay off your mortgage without any early repayment fees and your company has excess cash, then you can essentially take a loan from your business, use it to pay off the mortgage, pay the HMRC minimum approved rate of interest back to your company. And the real trick in here is there's a special tax called Section 455 tax, which comes into effect if you, as the director shareholder of the business, have a loan with the company. So you owe the company money that's over £10,000 at least 9 months after your year end. And if that's the case, which it likely will be if you've taken out enough money to repay your mortgage, you have to pay this Section 455 tax. Now, it's a company tax, not a personal tax. It's part of the corporation tax regime. But the trick is it's temporary. You need to pay the tax to HMRC, and it's over 30%. I think it's 33.75% of the value of the loan. So it's not insignificant. You pay it to HMRC, and then once you've repaid your loan in full, the next year, when you submit your corporation tax return, you say to HMRC, I'd like my Section 455 money back, please. And they give it back to you. So it's a temporary tax. But as you can see, this is only ever going to work if you've got a lot of cash in the business, not just enough to pay off your mortgage, but enough to temporarily give another 33.75% of it to HMRC for what is likely going to be quite a few years, depending on the size of your mortgage.
And presumably you just get the amount back that you paid. It's not the amount you paid plus interest.
I think you do get a little bit of interest, and it depends on how quickly you ask back for it. But no, I wouldn't use it as a savings account now. No.
Well, that's a brilliant idea. I think that will have gone down. I don't think that's an idea that a lot of people will have heard of as well.
No, and some of our more successful clients, and we do have quite a few very big clients with an awful lot of cash and very successful businesses. So I've seen this quite a few times over the years. We've got some director shareholders that take out money from the business as a loan, pay the Section 455 tax on it, but then use those funds to make an investment in either an SEIS or an EIS opportunity. And for those of you that don't know about those, if you invest in a SEIS registered company, a startup, 50% of your investment will get deducted from your personal tax bill. And I don't mean 50% of the investment gets counted as a cost, as an expense on your tax return. I mean of your actual tax. So if you make a huge amount of money and you pay a lot of tax, you can get rid of a huge bit of it by investing in SEIS. EIS is a very similar scheme where you only get a third of the value back, maybe 30% of the value back instead of 50 with the SEIS. But for a lot of people, they'll make more money by making investments in SEIS and EIS companies, using funds that they've taken out of their company, paying Section 455 tax on it, and then hopefully when one of those investments comes good and you get a huge gain, not only is it capital gains tax-free, which is one of the rules of these EIS and SEIS investments, but you take your profit from it, you pay back the company loan that you used to make the investment in the first place, and you get that Section 455 tax back. Now, it's very hard to know which of your investments are going to come good. Some of them might not ever come good. So you would only really want to do this on money you're willing to risk. But we see people using this kind of temporary tax access to funds a lot in companies that have a lot of excess cash.
And when the company, well, so I shouldn't be so morbid. If the company fails, if it fails, do you have to take your own money? Will you still get the tax back?
Do you mean if the EIS or SEIS company you invested in? Yeah, if they go bust, you don't get your money back from them. It doesn't negate your tax benefit, which is great. Yeah. But yes, that it does happen rather a lot that the companies don't succeed or they do go bust. Yeah.
Okay. Definitely still a good idea. And I presume as well a way of investing in another of your own companies as well.
Yeah, well, that's a really good question. So if you've got multiple businesses, but they're not in a corporate structure, like if you don't have a holding company and subsidiaries underneath it, because if you do, you can just move money between them completely tax-free kind of all the time. Dividends from one can flow up to the top with no tax, and you can then loan money down to another one of your businesses without any tax. So if you've got a group corporate structure, that's usually the best way to move money around. But if you have instead what are called sister companies instead of mother and daughter companies, so you personally might own more than one, then yes, that is something you can do. Again, you need to look at the whole situation. Are you better off just doing a loan between them at a commercial rate of interest? But yeah, say you want to start up another business idea, you could use the money for that.
Thank you. School fees.
Now this is another interesting one, and it's become more and more popular now that there's been VAT on school fees added. What a lot of people don't know is that there's many, many, many ways of having your company pay for what are really very personal things like school fees. You have to understand that the money you take out to pay school fees, or if you pay the school directly for the school fees, gets treated as a benefit in kind for you. So say you're the owner, director of the business, and part of your remuneration package is usually a pretty small salary, but lots of other benefits. You will get taxed on those benefits as a benefit in kind, but the cost is completely tax deductible for corporation tax. So you're definitely, if you're able to look at the ecosystem of you and your business as one entity, you overall save an awful lot of tax by doing things like that. So yes, talk to your accountant about, the best way to do it, and do understand that it does have to be reported to HMRC, but just as a benefit in kind, and you'll have to pay tax on that. But that's another really good thing to do. Again, if the company's got a lot of money, but you don't want to take it all out and pay dividend tax on it. I don't know if, we've talked about this before, but there's such a big difference in tax from taking out under £100,000 a year versus taking out more, that, we usually try and say to people, as long as you can survive That might sound horrible. If you can survive on 100 grand or less, do. There's a million other ways to deal with the profit you make above 100 grand, but taking it out personally is a killer tax-wise. So again, if you think about your school fees going into the mix, they do get counted as part of your overall income. Benefits in kind are treated as part of that 100 grand. So I'd be mindful of that. If your school fees are going to tip you over the edge, it's a little bit less attractive.
It's a good thing to bring up when you have your review with your accountant, I suppose.
Yeah.
And then the one I love, pension top-ups.
Yeah, of course. Well, I'm sure, as everyone knows, the kind of 3 ways of taking money out of your business. One is salary. We know that's taxed quite a lot. The second one is dividends. We understand the tax there. But taking money out to go into a pension is just the singularly most tax effective every way you look at it. Anything your company pays out into pensions gets counted as a taxable expense, so it reduces your corporation tax, but there's no personal tax to go on it whatsoever. A lot of people don't like the idea, if they're quite young, of things being, stuck in a pension pot that you can't access for a while. But it's really good to have at least some in there. It doesn't need to be where you put all your money. But it's incredibly tax efficient, unless, of course, you're an American like me, who gets taxed by the American government, even with great tax-free pensions in the UK.
Yes, we need that rule changing, Heather.
Yeah, well, I'll see what I can do about that.
Okay, let me go. Oh, I've lost myself. Here we are. So, smarter ways to deal with excess cash.
One of the things that pains me so much, if I look at a client's balance sheet and I see they have a lot of cash sitting in their current account, it makes me want to cry. It's such a shame to have a big pot of money and not have it work for you. And putting it in a current account it's like burning money, if you ask me. So there's a bunch of different ways you can make your money work for you. The simplest is to move it into a savings account. And depending on your bank and depending on what interest rates are doing at the time, you can probably get 2 to 3% pretty easily now with most major banks, just by opening a business savings account and moving your money into it. Now, you might say, oh, who cares? It's so small. Well, for doing almost no work, it's a way to make money. So you absolutely should. If you're willing to tie up your money for a little bit longer, again, most high street banks will give you a higher rate of interest. So if just putting it into an instant access savings account might get you 2-3%, if you agree to tie it up for 6 months in something, they might give you 4, maybe even 4.5% now. So it's always worth asking your bank what options they've got. But the other things you can do is there's lots and lots of places you can get overnight deposit accounts. For instance, I think Wise Bank right now, you can open up a Wise Bank account and they've got different rates depending on what currency you've put in there. But you can usually earn a little bit more than a high street bank with Wise. What we've done, we've opened a company investment account with a company called Invest Engine. But there are a couple of other ones out there where you can put your company's money into your investment account. And if you're not really a risky kind of person and don't want to put it in the stock exchange or in any kind of risky investments, you can put them in their overnight deposit accounts, and earn 4.5%, I think it is right now. And it's instant access. You can get at it immediately. And what's great about those, like a company investment account, is you can split your money, some in very low risk, some in slightly higher risk. We have a big chunk of our money in ETFs, exchange traded funds. So we don't want to try and pick individual stocks. It's just not what our expertise is or anything like that. But we can just put it in, say, like a FTSE 500 or a New York Stock Exchange tracker kind of index fund. And the other really nice thing about those is when it comes time to pay tax for your UK company, until you've actually realized those gains, say your fund is getting bigger and bigger and bigger, if you haven't cashed that in and taken any money, you don't need to pay tax on it yet. So your accounts will show that you've got some extra investment profits, but they're not taxable profits until you cash them in and use them. So I like having a mix between the two. We've got some in the overnight deposits and some in the funds. I also have some of our own company money in Wise. I've got it in 3 different currencies. I like spreading it out.
And does it take you a lot of admin, I think is probably what's going on in people's minds?
No, really not at all. The way we've set up the external investment fund is that it's automatic. Every week, money comes out of our bank account and goes in there. And again, it's automatically split into the 2 areas we like. And you can do that and never look at it again. Or you can if you want to fiddle with things, you absolutely can. And it's very simple to do so. But even the Wise accounts we have, they have an automatic link into our accounting system. So you can see, either looking at your banking app or your business accounting app, immediately how much money there is. It becomes a bit of a hassle if you're trying to move around everything out of your current account and then move it back just when you need it. That, I would always say, is not worth the hassle. Because it does require looking at things a lot. And number 2, the one time you mess up and you forget to bring enough money back in, you might get so hammered on penalties, it's not worth it. Always leave a good amount of cash in your main current account for sure.
And do you do that as a formula, like a couple of months worth in your current account? Or?
Oh, again, it's a very good question. For some people, they like to have either 3 months working capital or 6 months working capital sitting in their current account. For me, it's much simpler. I look every 3 months. The biggest bills are going to be your VAT bill every quarter. A lot of people have quarterly rent payments. You look at what's the most amount of money that could come out in any of that period. And I always like keeping that amount in the current account. And again, it depends. Your business might be much more, its cash might fluctuate up and down a lot more, in which case you're going to want to think about it a different way. But if you have a very steady income stream, looking at your typical 3 months most expensive bills is usually the right way to go.
Okay. So thank you. Shall I move on?
Yeah.
Okay. Tax ideas. Paying tax early is one of them that you mentioned.
Paying tax early, people will think I'm mad. But as long as you pay your tax to HMRC, I think it has to be at least 2 weeks early. It's not if you pay it a couple of days early. They will pay you interest. Now, the rate of interest depends on what the Bank of England base rate is, and so always check on HMRC's site. But I think the last time I looked, it was about 3%. So again, if you're someone like me that saves all their corporation tax, way before it's due, you keep it in a pot someplace, why not just pay it early to HMRC? You're going to earn interest on it. And again, if it was the only place you were going to put your money, I probably wouldn't do that one first, because you can probably get a better rate of interest with a bank. But again, if you like spreading it out, it's not a bad idea to pay your tax early.
Yeah, 3% is not bad. I suppose if you're someone who's not currently doing anything and just having it all in your current account, paying some early and getting a slightly better interest rate is a little win straight away.
And of course, HMRC has 2 different rates of interest. It's the rate they charge you if you're late. That's way higher than the rate
Okay.
they pay you if you pay earlier. So it's not as big as an incentive as making sure you pay it on time. And I think the other thing on your screen there, the reclaiming the temporary tax, is that Section 455 tax I was talking about. What is nice is it's not a personal tax, it's company tax. And say that first year you take out your big loan to repay your mortgage or for whatever you want to do, the day you pay over that money to HMRC, that's going to sit in your balance sheet as an asset because it's money that is owed back to you. So as long as you one day repay that loan, you will get that Section 455 tax back. If you never repay the loan, say things go horribly wrong, and you're never going to be able to repay that loan, traditionally what happens is it then gets treated as a dividend out to you. And shock and surprise, HMRC has already taken the equivalent of about dividend tax from you, from your company, and now you don't get it back. So they've thought that through.
Yeah, they know what they're doing.
Yeah.
Okay, the wholly and exclusive rule. What's this all about?
So I have to give a shout out to my friend Rachel Harris. She's another accountant. You can find her on Instagram and social under 𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏. But she's so good at understanding the wholly and exclusive rule. I will, again, bastardize a story that's really hers, and I won't get it exactly right. You'll get the gist. HMRC is very, very good at understanding that every business is different, and what might be a valid business expense for one is not for another, and vice versa. HMRC is really concerned that whatever you buy and you put through the company for the company to pay for, it has to be wholly and exclusively for the business. So, for instance, you can't buy something that you're going to buy personally anyways and say, oh, but I also use it for business, so I'll get some or all of it paid for by the company. That doesn't work. Now, the interesting kind of exception is if you can prove that whatever this thing is that you're buying is going to increase the profits in your company, you can't just suppose it will, you have to be able to prove it, then HMRC will allow it no matter what it is. And go and look up Rachel's account to find out more. But let's put it this way. She got someone's boob job accepted because they had a business in OnlyFans.
Oh, I see.
Yes.
That's not going to be my niche.
That wouldn't work for my business or yours.
Well, okay. So we we can put her Instagram around, but Rachel Harris, accountant _
Accountant she. Yeah, that's right.
Perfect. Okay, and what about ideas to protect your cash? I think some people are nervous of having too much.
Yeah, here in the UK, the banking system only protects up to £85,000, I think it is, per banking institution. It's not per bank account, it's per banking institution. So that if the worst happens and there's a problem with your bank, you may lose it all other than £85,000. And in America, I think it's like 250. It's very different. So in the UK, people do get nervous about cash, and depending on how long you've been alive and watching banking issues here in the UK, it's not unheard of to have a run on certain banks. And even really recently, I think it was only about 5 years ago, maybe even less, one of the huge banks in America that services UK businesses with American interests, Silicon Valley Bank, pretty much almost went bust, ended up getting bought out at the last minute. So if you are nervous about having your cash all in one place, then you might definitely want to look into having different bank accounts with different banks. We've already talked about some of these. You might have Wise just as a savings account, and you might have your main current account with one of the more traditional banks. You might have money in an investment account like InvestEngine or something like that. Now, I wouldn't suggest you keep only 85 grand in as many bank accounts as you need, because you might end up with more banks than exist in the United Kingdom. And another thing that a lot of people don't realize, some of the kind of smaller or newer banking brands are actually subsets of bigger banks. So it's important you find out whether what you think is your little new startup bank that you're going to put 85 grand in, it might be part of a much bigger bank. So it falls under the one banking license.
No, they're not new, but an example of that is First Direct and HSBC. I think they still are linked, but that was, you shouldn't have 85 grand with HSBC and First Direct. You'd only be covered for one.
Interesting.
Okay. Shall I carry on?
Yeah.
Okay, so before we, go on, Heather, you go.
I was going to say, if we're at the end now, there's one thing we haven't talked about, which is a really important potential way of saving tax and getting your company cash to work better for you. And this rule is actually so strong and powerful that I have recommended people get married just to take advantage of it. But if you have a husband or a wife and you are the sole owner of a business, by giving half of it or however much you're happy with to your spouse, it's actually transferred tax-free, and it means that any of your allowances, remember I talked about that 100 grand a year, and it's the same with any tax band, it goes up depending on how much you use. You can double your lower tax bands if you split your ownership amongst a husband and a wife team. So yes, I think that's another really important thing. You remember how I also said if you have a loan at the end of the year that's over 10 grand, well, if there's two of you, then you've got 20 grand to play with. Almost all of those allowances get doubled if you put half or a portion of your ownership into your spouse's name.
Perhaps not romantic, but very tax efficient.
Exactly.
I used to have a list of clients that need to get married, and I'm actually proud to say there's only one left on there now.
Ah, nice.
And so I'll go to the questions in a second, but I think the most important thing is there's no point spending your time coming if you're not going to think about, well, what am I going to do following today based on what I've learned? So if you want to say it out loud virtually, you can always put it in the chat and just send it to us directly if you don't want anyone to know, or write it down, or tell somebody at work to hold you accountable. But I think having at least one thing that you're going to do following this call to make it worth your time is very important. So I'll go to the questions. Oh, sorry. Yes.
I just thought of one more thing before we go to the questions. People do ask a lot if they should buy a car through the company. Yeah. That's another one of those things. You could have taken the money out personally and done it, or you could do it through the company. And in general, if you're going to buy a used car, you definitely still want to do it personally. But if you're going to buy a new car, and in particular, if it's electric, then it's well worth using company money to do that, either leasing it or buying it outright. Buying it outright is usually the best way of doing it. Now, of course, I'm ignoring all the situations where it's a company car that's only ever used for company use. That, of course, has the best possible tax benefits. I'm talking more about you were going to buy a personal car anyways for personal use. Is it worthwhile buying it through the business? And if it is a new electric car, categorically, yes.
We can go driving around in 𝗵𝗶electrics.
Exactly.
Amazing. Okay. Well, we'll go to the questions. Just before we do that, I just want to let you know that you can get more of hints and tips on my Instagram. We also do a fortnightly newsletter where we have summaries of the podcast, little hints and tips. Heather's been on the podcast once already this year and is booked in for another session later on in the year as well. So if you want more of this information, you can see her on our YouTube channel. And then as we also do something called a financial diagnosis session. And these cost either $350 if you do them with Holly, $500 if you do them with me. And we project forward if you keep doing what you're doing, what are you on track to achieve compared to your goals? And you'll come away knowing what you need to do every year in terms of putting money away, what investment returns you need. So what's your investment hurdle, which I think is a really, really good number to know. Or if you don't do anything, what you're on track for already. So what's your worst case scenario, which I think can help a lot of people sleep at night. Or the last one is, what extra lump sum do you need? And I think this lump sum need is really important for business owners, because let's say that that lump sum here in this example, it's just shy of 100,000. You could sell your business for 100,000, achieve all your goals, then maybe that's job done. But if that number's 3 million, maybe you need the help of someone like Heather to give you a bit of a strategy.
And I will say, my husband and I have used Lisa's planning tool for years and years and years. It is super helpful.
Oh, thank you. And Heather and I are back for one more performance on the 11th of November at 10 o'clock. And we're going to cover all sorts, but again, the theme for business owners: managing cash flow, interacting effectively with HMRC, how choosing the best route to growth, I think, is something that a lot of people want to know. Well, I certainly do. So put that in your diary. Natalie will send out the invites closer to the time. So I will stop sharing because I can't do two things at once. And then let me bring up the questions that were already submitted in advance. Here we go. So Heather, I feel like we're on a quiz show. First one is, I have many years worth of cash in my company. I don't need to take as income. What should I do? I suppose you covered a bit of that, but
yeah, but that's a great question. And if you think about it, it's important to plan for when you're going to take that money out. I mean, Lisa, you must do this all the time with people as they're getting closer to retirement age, but there's ways to take all that excess money out of your business in a more tax efficient way, either drip feeding it some every year so you stay below certain tax levels, or planning for business asset disposal relief, what used to be called entrepreneurs relief back in the day. That could be a really powerful way of getting money out of the business, not tax-free, but at the lowest possible rate of tax possible. And again, if you're thinking about doing that, where you sell your shares or shut the company down and extract the money and pay this low tax, it's really important you give half to your husband or wife because the limit per person is now £1 million. So if you've got more than £1 million in your business, you suddenly want 2 million to benefit from this lowest possible tax relief. So yeah, if you've got that much money sitting in your company's accounts and you have no need for it, right away, and you're already using all the kind of options we talked about of having it grow for you even within the business, it's really important to plan how you're going to extract it, over what length of time, how much every year, and are you going to do one big lump sum at the end or not?
Okay, thank you. The next one is from a lovely lady who had a company which was extraordinarily successful, but perhaps her thing is slightly outdated now and she doesn't have the energy nor the desire to reinvent herself one more time in her career. For a bit of background, so how do I know when to call it quits? I have a reasonably large amount in the company, but each year I make less money as a business.
Yeah. This is going to be faced by more and more people now. People that had wildly successful businesses, that business might not exist anymore, in the next few years. The world is changing so much now. So yeah, it's incredibly important to know when is the right time to walk away, if you will. And back to the story about the fisherman who could grow and make more money to one day be happy and just sit around fishing by himself again. You really have to be able to think about what will make you happy. And running a business isn't easy. It's not easy. And so if you don't derive the same pleasure and enjoyment out of it, and it seems to be getting smaller every year, I would think really seriously about ways to gracefully stop or pass it on and extract your money and enjoy life in a different way. But also understand it's never all or nothing. You can actually scale back your business into something much smaller, but without shutting it down. Maybe go part-time, enjoy half your time and have half your time in the business. I would just be really mindful that constantly growing and constantly getting bigger is not necessarily better. And there's many, many ways to grow, and money and size isn't all of them.
I remember a client that we have in common who came to me with, it's like the weight of the world was off his shoulders when you told him, just stop and take the money out because you'll have more money if you actually stop. And then he pursued a passion project for quite a few years after that. And I think I think it sometimes needs someone else to just tell you. And well, you don't mince your words, Heather, do you? So you got very direct advice. And I remember him telling me that it was actually the December, I think, before lockdown. So maybe you're a bit psychic as well. And then the last question, it links into the other one actually, but this is a reasonably new-ish business, lots of get up and go. But how do I know when to stop focusing on future growth and when I have reached my ideal?
Yeah, that's a great one, and it's a tough one to answer. I'll give you, a personal example. When I started my business 22 years ago, I said, I'm laying down the law now. There's no way in the world we'll ever be more than 10 employees. I know that the dynamics in businesses of that size are different to small ones, and I don't ever want to do it again. Well, fast forward 15 years, and shock and surprise, we grew from 10 to 11 to 12. I think we got up to 16 people at some point. And I really should have listened to myself. And of course, the issues and the difficulties and complexities are so much bigger when you're still looking at that growth all the time. And the happiest thing I ever did in my life was stopping that and going right back down to where I knew I would be the happiest. And even though it was a long process and it was difficult, we ended up with the exact same turnover and profit after the reduction than before. So how to set your kind of target and to know when is enough and when to stop saving for future opportunities and future growth and when to just enjoy it as it is. I think most people only ever know when they've gotten too big and then they want to go down. It's very hard knowing before that. It's different if, say, you've done one of your investment plans and like, here's my target. Once I hit that level, I don't want to grow anymore. I want to protect rather than try and achieve even more. But I think for most people, you tend to grow until the bit that you're uncomfortable, and then you go back down again.
You teach yourself a lesson, maybe.
Yeah.
And I suppose different phases of your life as well, that if you're 25, you've probably got a lot more energy than someone who's 65.
Exactly.
Not always the case if you're my dad. He acts like a toddler most of the time. So I'll just see if anybody's got any questions. Do put them in the Q&A. Don't think anyone's been brave enough yet, but if you have them, put them in. We won't mention your name if you prefer that. But if not, I'll just remind you of the next webinar for Heather and I, which is Tuesday, the 11th of November, and it's called Inspiring Strategies to Scale Successfully. That's quite hard. So 11th of November at 10 o'clock. But thank you so much, Heather. I've learnt lots. I'm going to go and look at Wise because I only use Wise to do transfers to people. So I'm going to look at that. That's my biggest takeaway. So thank you.
Good. It was a pleasure.
Thank you. See you all soon. Bye.
Bye.